Good morning, I'm Bill Hubard, Chief Economist at Trade.com, and welcome to our weekly financial market review here on Core Finance. And now, this morning, our special guest is now Professor Stephen Pope from the University of Maryland College. Congratulations on your promotion now.
Thank you very much indeed.
What do we do now? Well, I guess the first thing is, last night we got the Federal Reserve minutes from the September meeting. Did they say anything unbeknownst to you? Any surprises at all?
No, I think that the Federal Reserve actually has begun to sound like the Bank of Japan back in the 1980s, where we are in a wait-and-see mood. They will be watching the data, particularly the inflation data, very closely and using that, plus signals from the market, i.e. the Treasury bond market, as to clues as to when might be the appropriate time to move federal funds higher.
I think it's quite interesting. Back in the old days, before Snapchats and this, that, and the other, the Bond Market Association in New York had a private Christmas dinner. And I go back to Christmas, this would have been Christmas of '85, okay, when we had a young gentleman by the name of Alan Greenspan on the Federal Reserve Committee. And I remember one young man from the Wall Street Journal said, well, Dr. Greenspan, how does the Federal Reserve decide to move rates? And he says, oh, we don't. You, the market, tell us the level, and we react accordingly. And after reading the first paragraph last night, it's just what you said, we will be reactive rather than proactive.
Yeah, and that's not what we need from a central bank, to be honest with you. And unfortunately, that seems to be the tone and tenor coming from all the major central banks around the world, that they are clearly looked at how the market has locked itself on and become so accustomed to these ultra low accommodative rates. And we've all seen the tizzy markets get into when they sense that there could be a hike coming through or withdraw the stimulus through.
Well, let's just very briefly look at, as you're talking about, okay? Now, as we know, pre and post minutes last night, markets still implying 76, 78% probability that the Fed will move on the 12th/13th of December, but still only implying not even 2 full rate hikes for next year.
No, and I think that they're very concerned that some of that steam that we know came from the Trump bump is beginning to dissipate, because you look at it and say, what progress has there been in steering the American economy onto a new path? Nothing on healthcare reform. Not much progress so far on tax reform, and until certainly tax reform comes through, it's difficult for businesses to make many new capital spending commitments, and that is holding the American economy back. So whilst that's the case, there's no need to be pushing higher on the rates at the moment, because you don't want to sort of dispel any incentive for investment further out.
The next big meeting, of course, is the Bank of England here on the 2nd of November. Now, we've probably moved up to 85, 90% probability. Your thoughts, right move, wrong move on raising rates on the 2nd of November? Or does it make any difference?
I think that probably with the state of the Brexit negotiations almost dead in the water. Now, a lot of that is because the Europeans seem to be refusing to negotiate. But I think with that going on, I sense that this might be a little bit too early to make that move. And when the loose lips were talking a few weeks back, it's going to happen. So we saw sterling jump up very aggressively, and now that's begun to evaporate.
And we see it now, well above 132. And then, of course, this may have sneaked into the market. Late Friday afternoon, the Office of Budget Responsibility said, we may have overestimated, we may have the miscalculation in reference to wage growth and stuff, okay? So, as you just said, we have the Brexit, which has always been an overhang, and now we're sort of, maybe the statistics aren't correct.
I know, and once you're starting to question the integrity of statistics, particularly from what we would feel is a sophisticated, diverse economy like UK, then I think it starts putting the timing that the central bank has used to raise rates into some doubt. And so I would say, personally, I think it's a mistake to go this soon.
I would agree.
I would like to see a little bit more clarity upon the economy, and certainly this dreaded Brexit thing which drags on and on, and see how that's moving.
Well, let's see how it's affecting the commodities market, okay? And it's one of the things that we've seen. And we've seen gold, 1275, 1315, depending on what Trump says or what Trump doesn't say. Where do you see it going more on a fundamental basis near term?
Well, I sense that gold is going to be pulled in both directions in the regard, you'll look at what are the risk factors. Now, this time last week, we were getting very concerned that America was almost ready to pull the trigger on some action with North Korea. That does seem to have dialed back a little bit. Then you're finding that the economy is not perhaps producing the job growth we wanted. JOLTS numbers the other day was not as impressive as we needed. So you start to wonder what's happening in terms of non-farm payrolls. Have we washed out at the moment the impacts of hurricanes, Henry, Irma, etc.? So in that regard, I think that it's purely even how you play the risk scenario. From the fundamental basis, I would say that gold is well supported at its 200-day moving average. We can see that was very much the case there in May of this year, and again around June, July. And I sense that now you've got the blue and red line, i.e. the 50-day and the 200-day moving averages very close to each other. It'd be very hard for spot to break below those. If it does, it's a whole new trend. But so I would sense that at this level, you're probably quite safe being long of gold, and probably you will see the chances are it's more likely to move up to around the 1325 level as against go right down below 1250.
But I mean, we do seem to be stuck in that range, and it always seems to be any movement up is not on any relationship with silver or platinum or palladium or even Bitcoin, so to speak. It's basically safe haven, not safe haven, geopolitical risk. Is that what is really moving it rather than the dollar or anything else?
Yes, I mean, those are the main drivers. You've got a seasonal effect because you have Indian festivals coming through, so there's some gold demand. But a lot of that is also met out of reserves, etc., which they build up slowly over the year rather than rocking the price too much. But all in all, this is just sort of swinging back and forth on the day-to-day news as against there being a genuine fundamental reason and trend as to be in it or don't be in it. But I think you're probably safer with this being because if you look at the way it's meandering, it's above its trend support lines of the moving averages.
Because, I mean, what you are seeing, or at least what I am seeing, more so in the stock market, okay, we're seeing more of a reaction on mining shares, etc., and even a couple of penny stocks, okay, that are gold related, more so in South America, okay, more the stable economies. You're seeing some fantastic moves in some of these, quote, penny stocks, far more than in the Glencores or the BHP bulletins and stuff like that. So it seems to me that people are playing this more from a low-end stock market rather than from the commodity itself.
Yes, I think if you've got the time and the ability to read into the balance sheets, then probably you'll get more sort of swing power by being involved in some of the smaller gold specialist stocks. The larger ones you mentioned, like Glencore or BHP, Rio, they are so diversified in their field, and at the minute they're struggling because iron ore is not doing very well.
Exactly
China is sort of trying to get rid of low-grade storages. They're trying to sort of focus upon running down the quality of good stock, so they're not necessarily replacing at the moment. So it's not helping the major miners who've got a big stake out in Australia's Pilbara. In that regard,
not only am I slick here, let's look at oil. Okay, where are we going here? It looks like the news coming out of OPEC and also an improving global economy, we're starting to see some upward movement in oil prices.
Well, certainly if you were to believe the comments from the OPEC Secretary General,
which we do, of course,
Mr. Larkindo, I think what he's saying is, we must all pull together and curtail the supply, including the shale producers. Yeah, that's going to work. And I think what you're finding is that the reason he's saying that so vocally is that the latest figures show that OPEC production is beginning to trickle up a little bit.
Yes.
Not going down as it should do out till March next year and maybe longer if they had their way. So people are beginning to grow tired of this because they're not getting the appropriate revenue in to their economies.
But also, I mean, it was just a brief article in the FT this morning talking about participation, and they include, of course, Russia being, and it's talking about we're starting to see close to high 90s, where only like 3 months ago it was like 83%. But I mean, we do seem to be, 51, 52, 56, 57 on Brent. Now, what do you think we need to move that up to the next levels?
The only way this particular commodity base is going to start moving higher is if there is an immediate geopolitical shock.
Okay.
Now, whether that comes out of the Korean Peninsula or some other event that's in the Middle East, Middle East news seems to have died down somewhat at the moment. Because at the current time, as we've said so many occasions at these meetings, every time the oil price moves up, it's just an incentive for the shale producers to come on now.
Yes.
And we know that they're beginning to come back on stream after the impact of Hurricane Harvey. So that is not going to allow any amelioration in the supply. We can see now some of the OPEC people have grown tired of this restriction, and they're beginning to cheat, and they're putting the markets out there. You have Nigeria and Libya want to actively up their production
Because
levels.
even with this, I mean, I know we were worried in this country saying that, after first it was Harvey, and then even before Irma struck, petrol prices were going to go up 4 to 6p. I think maybe it went up 2, and the oil companies only use this as a ploy to move it up rather than move it down. But there doesn't seem to be any problem. Well, let's look at the next slide here. Okay, now
here we dip into the theoretical world of economics and managerial economics. And what I want to show you, this is saying the price and quantity that's indicated here is for a revenue maximizer, i.e. they are producing to the point where marginal revenue is at level Q, the output is level Q, because marginal revenue is 0. Anything above that, they could still make a bit more money on the margin by producing more. So at that point, they have got as much as they can before they start losing value. So that is where I sense that the shale producers are. They could possibly be out where the ATC, the green curve, crosses the average revenue curve, because then they're a revenue maximizer, or a sales maximizer. What I sense is that OPEC so desperately are trying to become, at the moment, a profit maximizer, where the marginal revenue line, that first diagonal red line, is actually cutting the purple line marginal cost. So marginal revenue equals marginal cost, which means you maximize profits. So I think there is a disparity, and whichever position you say OPEC are in, the shale producers are the next stage out. So you can see they are trying to restrict output, whereas the shale producers, they want to push as much out there as possible at the current time, maximising the output, bringing the prices down. And that is the war of attrition that's happening here. At the end of the day, the fact that the shale producers are able to switch on, work very efficiently, I think means that they are going to win the argument, and not OPEC, which we know. It's as solid at holding its argument as a block of Swiss cheese, i.e. it's full of holes.
Because, I think, we've seen this, Baker Hughes now seems to be flatlining. There doesn't seem, they've already made the huge increases. But as you say, I think, not that they're on their last legs, but OPEC does mean that the good times are definitely behind us rather than,
Oh, yes, and I think you can find it that if you look at job prospects for any expatriate in those Gulf states, they're disappearing fast because there is no oil revenue coming through. No. They can't fund their own federal budgets, and so they're really having to focus upon just jobs for the locals as against the expats.
Well, let's see our last slide here, okay? Now, again, one of the things, again, we're talking about, and I think this is important, about coffee.
Yes, well, we've chosen coffee as a representative of the agricultural commodity space because for a long time now, this sector of commodities has been on the back foot. Everything has been heading down and down, and wonders why. Well, a lot of it is because of the way the speculative players, the hedge funds, have tilted their investments. And the last couple of weeks, they've started shifting back to almost record bearish positions. Now, in coffee, you can see it's had a few spikes in recent times, from around June, July. But look, it's sandwiched pretty much between the red 200-day moving average and the blue 50. And it's really grinding through. And the reason why this is not making much progress now is because any time we sense there might be some dry spells, so it's going to ease up on the crop production, prices will move up. But of course, then rains come along, people start reviewing what's going to come to flowering stage, what's then going to go to crop stage and grindings, and it puts pressure. And at the moment, there is a very wet season going on in Brazil. It's improving the crop outlook, and so there is pressure on this price. And if you look across the entire space, whether it be cocoa or soybeans, wheat, and so on, you can find that how the weather is can affect them at different times in different ways. But generally speaking, this soft commodity trend is still going down.
Now, are we seeing... And I think about the pizza wars from several years ago, okay, when we had, again, a problem with wheat. Then all of a sudden, China, I think, allocated like 1 million acres. Are we seeing with the soft commodities, are we seeing more global distribution in the 21st century than we saw 25 or 40 years ago? Or are there still just the usual suspects growing coffee?
I think you still have to look and say, well, Brazil is the largest producer of coffee. However, people now are very keen to go and look at, well, what's available from Africa in particular, but also Southeast Asia. So there are other players on the block that can step in and fill any gap that one particular region's climatic chaos can cause to the crop output. So we can have substitutes come in, fairly quickly because in this interconnected age and good transportation links, things can move around the
Because
world
I know it's
very
quite
well.
interesting, you know, with Vietnam being a member of the ASEAN, it's one of the things that was recently talked about at the last meeting about more distribution of commodity-related economies. And as you said, yes, Brazil may be number one, but number 2, 3, and 4 are changing and coming up much quicker. And you would see this, again, with a global distribution with
That's right.
the soft commodities.
That's right. It used to be that Brazil was the standout producer,
Yes.
and the second place was really a long way behind. That gap has closed considerably, and because they are located in different parts of the world, it might mean that there's bad weather in Brazil at one point, so that hurts the crop, so the prices shoot up for Brazilian coffee. However, we can switch our attention to another area which has been blessed with good weather, and we can get good quality crop at a much cheaper price. So the substitution factor is very rapid nowadays, even though we get tied into long-term contracts. If they can't deliver what they've promised you they will, then you can go and snap it up elsewhere.
Well, I just want to thank Professor Stephen Pope, and after your conversation, why don't we go and have a coffee? And thank you very much, and we will see you next week.